Millennials, they want to have an impact with their money. And so what better way when there's a huge shortage of capital across the board, bring more women into the marketplace to learn how to invest this way, to leap the wealth gap and reach out and invest in those women-owned businesses. We can all rise when more women are able to get money because more women that have the means are investing in them. We can change the world. We can change those numbers. We can move the needle.
Gloria Steinem once said, "We will never solve the feminization of power until we solve the masculinity of wealth." Barbara Provost and Maggie Nielsen are the team at Purse Strings that will help you navigate the ins and outs of financial independence so that you can be financially fearless. This is Women in Money, the shit we don't talk about.
Karen, welcome to Women in Money, the shit we don't talk about. We are excited to have you here today. But before we dive into our wonderful conversation I'm eager to have, could you share a little bit of who you are and what you do with the audience?
So sure thing. And I'm really excited to be on this podcast. I think your title says it all, right? Because, women don't talk about this shit very much. And that's part of the reason why this book that I wrote. And, so my background is, I came out of corporate America in pursuit of, it was during the time when the dot-com bomb was about to happen, but in my corporate bubble of IBM, working with innovative companies to get them ready to go get venture capital. I actually didn't know that there was a dot-com bubble happening. And I teased that because I was working with so much innovation. It was so exciting. And I wanted to be in that parade, but I came to find out that the parade was sort of like the Animal House parade where they would go down the alley into the dead-end alley and they're all bumping into the road. And that was my parade because I left in January of 2000. Right? To go help this company, this real software that could change the world, solve lives, go get money, and I hit the walls. But it put me on the path and the trajectory that I am and where I am today. And it's really kind of crazy sometimes when you see the twists and turns, the doors open, the doors close that you go through. And I remember walking into that very first angel investor meeting I had been invited to and going like, well, first of all, I had no idea that these kind of people existed. I mean, logically, it made sense after the fact that before somebody is bankable, there's some form of money besides credit cards that gets them to there because, credit cards can only take you so far, right? And that turns out to be angel investors. They're the ones that invest to create the revenue, but then also bridge the gap when you need to wait for the revenue to come in, and how do you pay the bills, and how do you keep business going and keep developing and keep cultivating and generating new potential business and so on and so forth. And so that was the first thing. And the second thing I noticed that everybody in the room was a middle-aged white man, and they were the ones that had the seat at the table that were picking and choosing who was going to be the next big thing. And I didn't really, I would have always been confident, or at least outwardly confident. And so I was like, okay. And the founder of that, Jerry Martin, saw something in me. And I initially started in the group sort of as the Vanna White, here's how you turn on the projector, and here's how you register people at the door and all that kind of stuff. But I also had the opportunity to screen the deals that were going to be in the room. And that gave me a great deal of experience in looking and having the conversations with the investors on why did you invest in this deal or that deal, or, what did you learn? Why, and learning from them what they were going through. And as we'll get into the questions, I'll explain more about how I came up with this idea of compassionate capitalist. But it was really from that idea. And I ended up, he nurtured me to take over that organization, mentored me, and I ended up, taking over or starting to run the network of business angels and investors, and rebuilt it to be one of the most active in the country, top 50, and one of the most active definitely in the Southeast in the number of events we were having, the deals we were screening, the amount of money that we were investing until the Great Recession happened. And during the Great Recession was when I had always used the term compassionate capitalist as my sort of like my identifier on my cards, But I changed. I started doing podcasts back then, and it was called the Southeast Private Equity Conference. We were doing a big event of companies pitching to a room full of different kinds of investors, and I called it Spec Talk Radio, and it was really for SEO backlinks at the time because nobody was really doing podcasts and nobody was listening to podcasts. But it was a way for us to, share with my audience of about 500 investors that had filled out their form telling me what they invested in, what their worth was based on ebooks that I had used to build that angel group back up. And ebooks back then were just PDFs you emailed people. There was no such thing as an ebook, right? And it became, that series of ebooks was how to be an angel investor, and then it was learn to be an angel investor. And it became the foundation, or the core content premise behind the first book, Inside Secrets to Angel Investing. And I wrote that when the Great Recession happened. I realized a couple of things. First of all, angel investors are, those early stage companies, those startups that are potentially creating a whole new market. They're inventing something that is going to be new way to solve a problem. And the ripple effect that has usually brings a lot of other commerce into the market. It creates jobs. It's where growth in our economy comes from. And I saw, a lot of my investors with money just sitting on the sidelines. And it's like, you got to put this to work. We've got to invest in these early stage companies, these startup companies, so we can turn our economy around. So I changed the thing and really started the compassionate capitalist movement, right? The idea that people would want to learn how to invest in entrepreneurs as an asset class because they, wanted to see change happen. They wanted to see problems solved. They wanted to be a part of that because that was what I realized when I first met those angel investors, that was really what they were doing. That was why they were making these kind of investments. And so I started the compassionate capitalist movement. I wrote the first book as sort of to launch that, to explain what angel investing is, to provide a how-to. It's a deep book. It's got, footnotes and, all kinds of stuff, and a glossary and all that kind of stuff. And as women in particular tend to do, it took me, because I was stuck on the old stuff I written, I had to rewrite, and rewriting can sometimes be worse than writing from scratch, which is the difference with the new book. The new book I wrote from scratch, it was a lot faster, it was a lot cleaner, and I was a lot smarter about how to go about doing it. But that first book, I sat on it for probably 6 months before I had the guts to put it out, because I was like, oh no, all these men that are angel investors that are like these honchos that I know, they're going to be like, who does she think she is writing a book about angel investing, And you also learn over time as a service provider, you sometimes don't make as much money. You definitely don't make as much money as somebody who invented something that the world wants, right? And so, I co-invested with my angels, but haven't really been a leader of, building a portfolio of investments. But it opened up the doors, opened up the opportunity, and discovered a whole bunch of stuff about why people don't know about angel investing. I mean, I called it secrets at the time because I always felt it was sort of a secret that this was an asset class, and the Jobs Act of 2012 was a game changer in that regard. But it was almost 10 years later before I really figured it out, and then building a course for people to be able to, the thing about a book is that it only takes you so far. And if you even get through it, as much as you try to take notes and do those things, if you don't really know, and you don't know how to get the answer to how to do this, whatever is is recommended, you just kind of freeze in your tracks. And so a digital course had to be made, and I had no idea how to do that and the tools to do it. I really didn't want to be one of those people that would stand up in the front of the room and say, okay, now the first 10 people that run to the back of the room and, throw your 10 grand down, you're going to get another 10 grand worth of benefit or something like that. I really never to me, this topic, this empowerment, this ability to create wealth the way wealthy white men have for generations was too important to sell it like a used car salesman. I needed to be able to sell it as what it is, a life-changing, game-changing strategy for your audience, for women to take control of their financial future and leap the wealth gap. So every time I would be on a stage talking about angel investing in the first book, I would inevitably have a young woman, raise her hand, younger than me, so young, right? Young woman, raise her hand and say, how do I learn how to be a crowdfund investor? And the first book it was really written towards an audience of high net worth people in corporate America, with big fat 401ks, making $300,000, $400,000 a year that just didn't know about angel investing because they weren't invited to the room, or geographically or time-wise, couldn't commit to the obligations that these angels do. And so I had to write one that was more digestible, that spoke to that person that was not really wealthy. I mean, although to me, crowdfunding is the on-ramp to angel investing. So even if you have enough liquidity and wealth to be an angel investor, you still can get started to get comfortable with the process and gain your confidence with crowdfund investing. And it needed to be relatable so that whether it's a middle-aged 50-year-old woman that's trying to figure out how to actually get ready for retirement and, have enough money for the next 30 years, or the millennial that just says, God, this corporate gig is just, is this what I'm going to do for the next 40 years? And how can they find passion and purpose in their life through crowdfund investing? And, that's why the book is named what it is, Inside Secrets to Crowdfund Investing. Follow Jane's journey. See how a new generation builds wealth with purpose, passion, and profit.
Okay, let me stop you right there because you've given us a wealth of information. I'm taking this all in because I've been down this road around VC pitching and things like that. And we all know the stats, right? How much money goes to women when they pitch? Less than 2%, right?
Yeah, right around 2 or 3%. It got up to about 6% in 2021. And
yeah, not a lot. Women of color, less than half of that, right?
Exactly. So 95 aggregate, at least 90% of all the angel investor capital and VC capital go to white male businesses.
Exactly. And I've read up a lot on this because even when women and men pitch almost the same business, it goes to men. I mean, they've done these studies on the pitch, right? And it's because of this groupthink or whatever it might be about who's going to be successful and who's in the audience, who are they pitching to. So nonetheless, what we do know is that women are opening new businesses every single day. More businesses owners are coming up, and women of color, even more so, are opening new businesses every day. So women are not holding back. We are still out there pounding the pavement and starting businesses and moving ahead. Whether we're getting VC funding or not, we're finding ways because we're scrappy, right? Just like Purse Strings has done, right? Bootstrap, credit card, whatever we needed to do to really make sure that our mission keeps moving forward. But you've done, what you've said is credit cards, then you talked about crowdfunding as the next step, and then angel investing, right? So there is kind of that crowdfunding step in the middle. For the listeners, can you decode what crowdfunding means and how it works?
So the thing about crowdfunding is it is basically, there's really 5 kinds of crowdfunding. The one that most people think about is reward-based crowdfunding, and that is where you give money to a company in exchange for something like a product or some type of reward. A lot of times movies are funded or get going that way because, I can be on the red carpet or whatever, you know what I mean? And donation is a reward-based type of crowdfunding. And then equity-based crowdfunding, being able to give money and get equity in the company like an angel investor, or similar to the way people might relate to with stock market investing. Equity stocks in the public stock market is the same as the equity in a private company. It's just not public. It's not transactional, the way you can't buy and sell it. Okay. And so there's 4 ways that in 2012 with the Jobs Act were legalized under crowdfunding. And the one that most people think about, because the names of the companies, Refunder, Start Engine, Microinvest, Republic, those kind of companies are Reg CF primarily. Now, some of those platforms have expanded and they offer Reg A Plus or Reg D 506C, but the main premise is Reg CF, regulation crowdfunding, that allows founders to raise capital through general solicitation. And that's the big differentiation with the securities laws and reason why angel investing was such a secret and such a closed society for so long was because of the security laws and how people were prohibited from being able to raise money. And then what's ended up happening with crowdfunding is there's a financial discrimination that happens on association with wealth as being knowledge and smarts. Okay. And so you can raise up to five, and there's this term accredited and unaccredited. Okay. And that's, based on the amount of wealth you have. And real briefly, it's individually household $200,000 a year, past 2 years with reasonable expectation to continue that income. And a household is $300,000 or a net worth of $1 million that doesn't count for your primary residence. Doesn't say about liquidity, right? Liquidity is really, because the bars are not that hard, but it's about how much money you have to invest. And so they say for Reg CF, $5 million, anybody in the country, accredited or unaccredited, the amounts they can invest is based off of income. And Reg A Plus is the same way, but you can raise up to $75 million. The technical nuances is that Reg CF is on a FINRA regulated platform, which is regulating the watchdog agency of the SEC, and they file your paperwork with the SEC. And they manage, the inflow and outflow of information and documents and capital and things like that. And Reg A Plus, you have to file SEC audited financials with the SEC as the gateway on that, but you don't have to actually go through a portal. But it's up to 75 million accredited, unaccredited. And then the real sort of the wild, wild west area is the 506C. So they took the regular offering that angel investors and entrepreneurs have used forever, which is the Reg D 506. It's a line item in the regulations. And so it's become this thing, but it's really just a couple of paragraphs in the securities law, right? And so 506C, you can raise as much money, unlimited amounts of money, but only from accredited investors that provide evidence that they're accredited investor. And it became B and C. And B, investors just they just self-certify. It's really easy to sign a thing saying I am, and you lie or not lie, but the entrepreneur is not on the hook for that. And it is a wild, wild west, I say, because they don't actually have to file any kind of paperwork until they receive the first money. So you get a lot of people out there soliciting that really haven't done anything that's worthy of being investable and can waste a lot of people's times, but that's happening. And then the one I love, which is the basis of my community-based capital concept, that is interstate exemption. They took the Reg D 504 and turned it into interstate exemption, and that is, depending on the state, not every state does it, but in Georgia, it's up to $5 million from accredited and unaccredited within the state of Georgia, businesses in Georgia and things in this Georgia. You can raise money from your sorority, from your Rotary, from your chamber, from your church, from your community, from your customers. That's the big differentiator and the value of crowdfunding. And so, whether it's $100, $1,000, $10,000, you can play in a company at all kinds of stuff where angel investors, the typical average amount is $25K on a check. Although a lot of angel groups, it's much smaller amounts that gets aggregated to a bigger amount.
All right. So you do some crowdfunding, see if you can do that. Then the next level would be angel investors. And how I heard you describe an angel investor is a woman who's typically, or we'll say women here, making, 200, 300, 400K, has a big 401k, so they have money to invest, and they could write a check for 25K or 5 or 10 or whatever that could contribute towards some funding towards entrepreneurial, maybe a women-owned business like purse strings or something like that.
Yeah, absolutely, yes.
So Karen, is your side more getting women to invest in other companies or helping female companies get investors, or both?
Really both in a way, because my bread and butter is helping entrepreneurs figure out why they're struggling to raise capital or start right. But, a lot of times I end up getting people knocking on my door when they're finally tired of getting no's and they want more yeses, because it's hard enough to attract investors, but it's easier to attract it than it is to get them to write the check, of course, right? That's the top of the funnel. And so they don't understand how to build their funnel. They don't understand the follow-up. They don't understand the reasons why investors will reject them. Like at the very beginning of the process, when an investor is going through their screening process, they're looking for reasons not to invest because they have to narrow it down. And that's a contrary concept to entrepreneurs, because entrepreneurs are always like, look at me, I'm the most beautiful peacock in the room, right? So they don't understand that they could have warts that make an investor not invest. For what we talked about, like you mentioned at the very beginning, of the gender bias in the room, right? So women that are pitching to traditional angels in an angel room have to be able to become really comfortable in their skin. Like they got to be really comfortable. I learned this story or figured this out in a way that it surprised me, because when I was running my angel group, I really believed that money was green and that investors only saw green. If they saw a company and they believed they could make money on it, they would invest, right? And then I had this woman pitch her business that was a real game changer, because this was back before, when mobile phones were first coming out, and we didn't have mobile apps. We didn't have like this idea of look at it on a computer screen and here's how it reads, shuffles to be a mobile app. And so you had, like, she was in the advertising industry and primarily in the garment industry, and had a lot of these like Macy's and stuff clients that were trying to sell online. Remember, you had to scroll way over and like scroll way over to try to like see what was on the screen, because it wouldn't stack it. It would, right? And so she had a way to stack it, and as a technology for these companies. And she had presented her numbers, which were good, but the investors weren't excited. And I was like, and I talked to him like, why are you not excited about her? She said, oh, the opportunity is so much bigger than that. If that's what she thinks, then she's not the one to run the company. She needs a man that will run the company, that will see the vision of this, of where it's going to be. I wouldn't trust her to be able to build this company because she undervalues her opportunity. I was like, oh my God. And I told her that, and she'd stop doing that going forward. But she was like, of this, which is what sometimes women say, well, I want to be conservative. I don't want to overstate what the opportunity is, because they won't believe me. But if you know your numbers, if you are comfortable in your skin and you know your market, you can overcome that gender bias that they have, because they can't deny the numbers and they can't deny that you know your numbers, right? And so, that's a big part of it. So I do try to work on that perspective of it, but because there is such a shortage, and the reason why the course, Compassionless Academy, and this book was so important right now, people have sort of finally woken up to the fact that real estate is not as great of a solve all your problems for retirement as they thought, because if you have to own multiple mortgages, you got to have enough income to cover those mortgages. And crypto is like, what, man, that's kind of complicated. And if I'm not in at the ground floor, and it's transactional, and women in particular want to invest with purpose. They want to have an impact. And millennials, they want to have an impact with their money. And so what better way, when there's a huge shortage of capital across the board, bring more women into the marketplace to learn how to invest this way, to leap the wealth gap, and reach out and invest in those women-owned businesses. We can all rise when more women are able to get money, because more women that have the means are investing in them. We can change the world. We can change those numbers. We can move the needle. That's really what I'm really passionate with, the message that I'm trying to put out there right now.
Well, you are preaching to the choir, I'll tell you that much. We are 100,000,000% behind you.
And it's so funny that, like, when you were telling that story, that's something I would so feel like if I was getting an investor, I knew I would need to hit that mark, where I've had plenty of men who I know who are like, well, I was pretty close. I was 80% there. Where to me, like, if I was 80% there, I'd be like, I failed my investors. You know what I mean? I didn't achieve on my promise. So it's so funny how they didn't do that investment, because they she was being conservative, which I could also see, because you don't want to overpromise and underdeliver. But I know you've helped a lot of women move past this investing exclusivity or risk kind of story. So what's like a simple tip you would recommend for a woman who wants to start but feels intimidated?
It kind of goes back to like the know your numbers thing, right? You overcome being intimidated with confidence. And the way you get confident about investing this way is to do some basic things like what Jane goes through, right? In the book, in her process, right? It's figuring out, how much do I have? Well, how much can I afford to invest? So you don't have the anxiety of, am I investing too much? Is this too risky? You can only invest what you know you can afford to lose, because as with any investment, there is risk. There is always a chance that you lose it, right? So the first thing is how much? And then the next thing is recognizing that we don't give ourselves credit for what we know. A lot of times we know things that we don't know. So like in the case of in Jane, in the story that I roll out in the book, she's a nurse. So she kind of knows healthcare. She knows stuff. She knows problems that are going on in healthcare. She's a mother. So she knows things that, that about products that mothers want, or problems that, new mothers have, or whatever. She had family issues. She knows things, child education. She's had her kids struggle with learning stuff or whatever. You know things from life experiences. And in this case, she's a outdoor enthusiast. One of the things that she looks for is somebody that's solving a problem with portable kayaks. Okay. So the first step is how much to invest, and then figure out what you do. And I have a tool that's part of the Compassionist Academy that helps you figure that out. You grade yourself on these different topics and things so it's learned knowledge, what you went to college for, right? And you learn this stuff, but a lot of times we're working in a field that's different, or we have interest and life experience. That's our earned knowledge, things that we've learned. So give yourself credit for those two categories of what you know. And then it's really the biggest thing, and this goes to any kind of investor, really resisting emotional investments. And women, we tend to be emotional. And so we love something in it. And I've made this mistake. Every investor, right, where I kind of came up with the Compassionate Capitalist name was because investors that were just learning by losing, right? But I was like, you're passionate about something that you want to invest in. So you've got to have this objective thing. And so I created this angel profitability blueprint to help people sort of go through that process of being very specific. So the idea is you're going to first invest in things that make some money, so you feel comfortable, like, oh, okay, even if it's a small check, it works, right? Because it can take a long time to get to an exit on something that's a private company. And then it's sort of like figuring out the things you're interested in, what are problems that you want to solve. So you look for companies that are solving those problems. You subscribe on all the different funder or the different kind of crowdfunding platforms, so you get alerts of companies that are doing stuff. And then when you find a company that's solving something, a problem, and I give examples of this in the book, but whatever it might be, then you go find two other companies that are trying to solve the same problem in a different way. Because I guarantee you, there's a problem out there. There are multiple people trying to solve that problem, and they're approaching it in different ways. So you figure that out. And this is one way that crowdfunding has an advantage over angel investing, because we can see lots of things that are going on. With angel investors, they typically only get to see the deals that walk in the door, that got screened by somebody else, and maybe word of mouth or something else going on in their community, but they're rarely looking like I'm in Atlanta, they're rarely looking for something that's going on in Charlotte, or something that's going on in Phoenix or Chicago or something like that. They're not flying up to Chicago to go to a meeting, right? They don't know about those deals. Crowdfunding, you have an advantage, and you can discern and then find the one. And then if you're still nervous, and then if you use a tool and you make a decision, I just love what this person doing, I love this thing, then you're making a conscious decision that you're putting your finger on the scale of emotion. And then you start small. Right? I call it the West Coast mentality. You start with a small investment, see what they do, and then you can, as a crowdfunding platform, you might say, oh, I'm going to put 500 in, and then I'll see what they do, because they actually can go raise that 150K that they're trying to do, and then they do something with that, because they're going to come back around. And if they get to the end and they look and they're giving you regular reports and you're hearing about them and you see their progress and you're developing the trust on that, then you come back in and maybe throw $2,000 in too, right? You can do that, and just be patient in the process as you develop the relationship with the deals that you want to invest in and want to support.
So cool. And then what can the investor expect back, and when they're making this investment?
So part of what I teach in the Angel Profitability Blueprint is diversification. And that is, if just look at the rate of return of angel investing over other investments, it's usually 3 times as much. And they, of comparable size portfolios. And that's because it does have this huge upside potential on some of them, but not everybody does that upside potential. And the companies that you know of that do 10x, 20x, that are the big IPOs, the big name brand IPOs you hear, for every one of those, there's probably, dozens that just sell their company for 2 or 3x, 5x kind of a thing, a multiple on the money. And then there's the ones that might have a base hit or something like that. But a diversification is really the key. And so that's why I start with some form of revenue share or debt so you can find the really good deals. And then it's diversification by industry and by stage. So you can get in on a startup that might have, because it's earlier you invest, the riskier it is, but the biggest potential there is, okay? And then if under Reg A Plus, because those are usually companies that have a strong track record already. They're raising capital to bring out a new product or to make acquisitions or to do something that helps them expand in such a way that will lead to them being able to have a good solid market cap to be a public. They're going to be an OTCBB or going to be, like a small cap. They're not going to be, huge, cap companies like a traditional IPO, but they'll be fully trading. And then you might only get 2x your money because you're at the end of the life cycle before that company exits. But you want to be able to diversify like that. At the end of the book, I use an example of comparing to a 401k. And I put this in there because I talk about it, but then I realized, wait, I didn't even say this in the book. And part of what I am is trying to give hope to millennials. And I got this idea, and then I did the math from it. Jason Kokonis was one of those. He wrote a book called The Wings of Angels at the same time it came out, same time my first one came out. And his claim to fame is that he's in Silicon Valley and he invested in some of these big name things like Uber. And so it was really about the angel culture and his experience in that. And mine was more of a how-to. But on his podcast, he was interviewing the founder of Seed Invest. And he said at the time, if I could go back and talk to my 20-something self, I would tell myself to not go start that first company at 20 or 25 or 26 or whatever. I would have gone and got a corporate gig because then I would know how companies work. What's the good and the bad of corporate practices and how do you team and how do you do that stuff that I didn't really have experience, and I failed my way forward learning that. He says, but instead, and I knew I wouldn't have my 401k, but instead I would throw $500 a month in a Reg CF company and I wouldn't overthink it. I would just start doing it and watch what happened, learn their business models, look at this stuff, see what kinds of things, and learn from all these other startups and founders and stuff. He says, and at the end of the day, I would have 4 or 5 times the amount of money than I would if I had done my 401k. I was like, is that real? Right? So I did the math and I verified it with AI. And, so if you think about that, if you go through the math on that, it's 5 years would be 60 companies. So you do 6 sets of 10. And the VCs out there kind of created this, everybody uses it, the portfolio of 10 companies, even though, you want to have a lot more in your portfolio than 10 over time, but start with that. And so you'll have 1 10x, 2 that are 2x, 2 that break even, and 3 that go out of business. Okay? So out of that thing, so this is, for 60 companies. So if you add that up, and of course this is just for an example, and it does take longer than 5 years, that kind of a thing. But if you had invested in your 401k, a typical type of return, 9% or whatever, not counting fees or any of that kind of stuff, you're going to end up with $36,000 roughly. Okay? If you do the math on the 10, 5, 2, and so on, you're going to end up with $78,000 and even with 18 failures. And so that says that the compounding diversification and building up a large of like 60 companies, your odds of success grow with diversification of stage, industry, and type of offering. And you can, outperform any other asset class.
I love that. I love that way of thinking. It's so, let's get out of the standard protocol of everybody putting their money in a 401k and really think out of the box. And how can we really help others, as women always want to do, invest and grow other companies, right? Especially women who are trying to grow their companies. I think it's brilliant.
It's another form of that value-based investing we talked about a lot. It's another form of, supporting those people that you believe in, building the wealth. It could just be more local communities, how you're also impacting your communities. It seems like it's like a little bit more maybe risk tolerance to get started, kind of a different education curve, but it still is just like regular investing, there's not beating the market. It's just small and consistent. Like he bought $500 worth of a company every month. It's not just like, oh, this looked like a good deal and putting all your eggs in one basket. But, the same, like you just do it consistently. You got to give it the time. Some are going to go up, go down. You can't be too emotional, pull in, pull out, all these different things. It's interesting and such a great opportunity as being one of those millennials. Some of that retirement does seem so far away. So you're like, wow, if this opportunity instead could double my money versus the 401k, growth or whatever. And again, maybe you do some of this, some of that. So it's not even just all investing in companies, but some is real estate, some is 401k, some is companies, and then diversifying the diversity from there. So you're just abstract piece of art.
Yeah. Well, and also the thing to keep in mind, and this comes back to the purpose and passion part of it, right? The impact part of it. The capitalism, buy low, sell high, right? It's transactional. Stocks, real estate, crypto, they're all transactional. But when you're investing in a company that's solving a problem, or in the community-based model, it's a business that you love that says, you know what, I want to open up a second location. I don't want to let my customers have a piece of helping me do that, right? You are investing money that founder is going to put to work growing. So in theory, it is always going to be at the ground floor growing up, or at least this way going up. Now there's, things that happen that make businesses go sideways and things like that. But, the biggest reason why most people fail, and the biggest reason why there are those base hits in a portfolio that I talked about that are break even, is because of the scarcity of capital. If they had capital to bridge that gap and to grow, they could be the successful entrepreneurs that would have the exit that we would all win from.
Yes, exactly. My question for you is, so when you want to invest your money, you go to a financial advisor who helps you diversify, invest, all these different funding options, so on and so forth. Who can help you look at these different companies and do this research and look at this onward investing every single month in these smaller startups, women-led companies? Who do you go to, or do you do that independently on your own through some kind of website that captures this information?
Great question, Barb, because one of the big challenges and why this type of investing has been a secret for so long, or has a bad reputation. If you can ask somebody that you would think would be an angel investor, and they'll say, "Oh, no, that's gambling." And the reason why they say that is because their financial planner told them that.
All investing is legalized gambling.
Well, yeah, in a way, right. Because of this thing called selling away, FINRA being the watchdog. It is unlike real estate, where they can say, yeah, we'll carve out $100,000 or $200,000 or $500,000 for you to invest in real estate. And they won't touch, traditional wealth managers and financial planners won't touch an equity deal, a private equity deal that's not through their broker, because of this selling away. They should be the ones that are, saying, giving you financial advice on allocations and things like that. So registered investment advisors, although are not held by that same level, because they're not getting paid commissions on the products that they're selling. Don't invest in this, but invest in these things, right? They're just giving you a holistic approach to meet your criteria, what you want out of life. But they don't always, because it's not for themselves. They don't really learn this either. So they may not be as skilled at it. So if you need to ask, I have a friend of mine who has lots of money. She goes, "Oh, I'm going to go ask my advisor." And I'm like, well, they may not know, you know what I mean? So take whatever they say through that filter of how they respond to you. Because if it's good enough for the most wealthy men for generations, since the 1930s when it was first legalized for, that pathway, for them to continue to do this over and over and over again, it must work. Right? And, if you think about all of the tech billionaires that did not do it alone. They became a billionaire by a few thousand people becoming millionaires. And so, you have to look at that and from that lens. And part of the reason the Jobs Act passed was for both sides of the equation. The government agreed that, yes, entrepreneurs need to have a better way to raise capital from their customers, from all over, not just, because you went to MIT and have rich friends, right? That anybody can raise capital from anybody, but also on the other side of the table for those investors to be able to catch up in the wealth game. Because if you recall, at the Great Recession, everybody had lost a lot of their retirement, whether it was in real estate or stocks, and it took like a decade for it to come back. But when you think about things that came out during that time under reward-based crowdfunding and all, digital watches, smart watches, 3D printers, drones, but even like VR headsets. If you could put $1,000 into Oculus, a kid in his garage that was inventing these things, and you got a headset that you could do virtual reality to. And then years later, when Zuckerberg paid $800 million for that company, what did you have? You had an obsolete piece of equipment. If you had $1,000 of equity, would it be $2,000? Would it be $10,000? What would it be worth if it went from where it was to 800 million acquisition, right? And so we don't know because we weren't allowed to do it at the time. So I also will be offering as part of the Compassionless Academy. So they have the training, it's step by step for intro level with workbooks and worksheets and samples and up to advanced level, but also a mastery class where people can, like a mastermind where a group of people will come together and compare notes on deals that they're looking at and help them discern and learn the skills of discerning how to invest, and even one-on-one coaching and helping. I do due diligence for angels. I've been doing that for decades. And so that'll be part of the offering of the Compassionalist Academy as well.
That's fantastic. And when is this academy opening?
Well, at this moment in time, when this goes live, it should be available. If people want to go to compassionalist.academy, they'll get a pop-up that gives them an ebook, the 4 W's of crowdfunding, but also puts them on a list for when it's announced, and they'll get 25% off the fees at that time for early sign up. And it's all done for this phase of the launch of the content. It's just getting all of this cash register stuff and the checkout pages stuff and not so fun stuff that I have to okay, Karen, it's time to take some Excedrin and sit down and figure this out and put it together.
You need a Maggie. She does all that.
This has been super interesting, and it's really just got me thinking of a new perspective of ways to invest, ways to help the community, ways to make money. And then I'm thinking of the guy who made the VR goggles. I'm like, wow, if he raised, I don't know, $2,500,000, I could see how that would still not be enough sometimes for different companies, and it could be a failure only because you didn't have enough money. So it's such a great opportunity for us to go out there and invest more money and help. So I'm glad we had you on, Karen. I'm glad we had this conversation. I'm learning so much, and I feel like it's just the tip of the iceberg.
Especially as the great wealth transfer comes through, and if we're educating women on how to really leverage and invest that money for women in the future, because women are not getting this money and investing in women-owned businesses, it could be a super cool way to invest instead of just putting it into the market, which is a great return for the most part, but it's a black hole unless you really know what you're investing in.
And there's so many of these companies. I don't want to fund some of these companies that are out there, So I'm like, what else is there?
Oh, yeah. Yeah. And one thing too, women tend to do better raising capital on crowdfunding platforms. I think partly because we're good storytellers, and we also tend to want everything to be just right. So the content that goes up there, you have to think about, for your entrepreneurs and your potential investors listening, that a good crowdfunding offer has a lot of detail in it, because like you expect when you're going to go and look at a public company and you want to know what their numbers are, what their industry perspective is, what their things like that. You want to have analysis. Private companies do that because odds are you're never going to meet the founder face to face. And so it takes out that filter that sometimes comes from the emotion of the charisma of the person that is presenting it. And it's just, does this business make sense? Do they know how they're going to make their money, put the money in the register, and how they're going to grow and scale?
Love it. So Karen, we do have one more question. This question we ask everybody before we wrap up here. And that is, what is your own definition of financial freedom?
Oh, real? Wow. To me, financial freedom is not worrying about money. Part of it is living within your means, but also have enough money, enough capital to know that you can go the distance, particularly since women do tend to live longer than men, but we also don't really think about that. So we sort of, particularly if we're married, we, sort of plan our life based on, our husband. And so in getting out, embracing the idea that you have the smarts to figure it out. As a woman, we have the smarts to figure it out. We have the life experiences. We solve problems, right? We like to plan. We plan, like, we cook, we plan meals, we plan vacations for the family. We plan. So why not plan our financial future and do the things you need to do that plant the seeds that you will be able to harvest as you go forward into the twilight of your years?
That's beautiful.
Kind of
Thank
poetic.
you.
Well, thank you, Karen, so much for coming on today and sharing your expertise. We'll have links to your books and all your programs in the show notes. Till then, be financially fearless. You've been listening to Women in Money, the shit we don't talk about. Now it's time to take what you've learned and make bold moves towards financial independence. Stay in the know by joining our newsletter for exclusive tools, resources, and updates that keep you financially fearless. Head to pursestrings.co and sign up today. Need a financial professional who gets it? Turn to Purse Strings' curated directory, your go-to resource for financial experts who know how to put you first. Love this episode? Leave us a review and help us empower even more women to own their financial power. Until next time, be financially fearless.